Good afternoon, dividend growth stock investors. It's Colby, the DGI Crab, and you know it just gets so easy to create content when one of the 60 stocks that you focus on your channel goes up in value by 25% in a single day, and that is exactly what Starbucks has done. Thank you, Starbucks, for making my job very, very easy today. What else could there possibly be to talk about when you've got a gain like this taking place? So, big congratulations to the Starbucks shareholders. And if you have been following this channel for a while, you know that I've been buying Starbucks each and every week for well over a month now. And if you're doing the same, well, you're feeling pretty good about it here today. So, all right, everybody, let's just clarify that I'm not a professional financial advisor. You should always do your own due diligence before investing in anything. This is just the opinion of one crab, blah, blah, blah. You know the drill. All right, so this is a case in point study here of why I buy quality blue chip stocks when I buy them. So, Starbucks has been one of the most undervalued stocks that this channel has focused on really since the beginning of the channel, just a month and a half or so ago. Starbucks has been in the buy zone on my tiers. Now, this is your first time here, just a quick reminder, this channel focuses on 60, that's right, just 60 high quality blue chip dividend growth stocks with a long track record of increasing the dividend, mostly wide moat companies, mostly S&P 500 companies with qualified dividend income. We're all about building passive, stable income on this channel that should consistently, gradually increase year in and year out. That's the point. That's what we do. And Starbucks, man, we have been adding it in the mid to low 70s, like I said, for the better part of a month now, maybe even longer than that, however long it's been down below $80. If you look here on my spreadsheet, now I go over this spreadsheet on Friday where we go over each of the four tiers. So the 60 stocks are split up into four different categories based on the age of the investor. Starbucks falls into tier 2 category, which to me are stocks that are best suited for 31 to 41-year-old investors. And that's based on the current yield and the expected annual dividend increases. So Starbucks has been in this green category for a while. On my spreadsheet here on the valuation, this is sort of doing a backdoor into what the Simply Safe Dividends website does. I'm comparing the 4-year average yield to the current day yield. And if it's in this green category, we've got at least a 30% higher starting yield than the 4-year average. Yellow is between 20 and 29.9. And red is everything else. And Starbucks, is, like I said, has been in the green this entire run of the channel. And it is now down here in the hold zone. So when it comes to these stocks, I don't sell them. I don't say, whoopee, I just made this 25% profit. Let me cash out and move that money somewhere else. It's not the theme of the channel. The idea that I am shooting for here is to buy these companies when they are on sale and hold them for the long term. So they will continue to grow and reinvest and increase my passive income for the long haul. Now, Starbucks, I've enjoyed buying it. It's been a nice run. I've made it a very nice, solid position in my portfolio, and it is amongst my top 20 holdings. And I'll tell you what, I'm happy now to just take a break. There's still other things that are on sale. We're still, waiting for some of these other stocks to recover. But Starbucks can just now sit in the hold zone and give me more of an opportunity to invest in some other things. So the question is why? Why did Starbucks jump up in share price 25% in a day? Well, they just poached the Chipotle CEO, Brian Niccol. I think that's how you pronounce that. Chipotle stock, I don't invest in stocks that don't pay me a dividend. Chipotle, I would love to invest in Chipotle. That stock has been an absolute dynamo in terms of growth. Why they don't pay a dividend at this point in the company's history, hey, you got me. They really ought to start, in my opinion. But they've got a, Starbucks has just picked up Brian Nickel. Um, they have ousted Laxman Narasimhan. Probably not pronouncing that one correctly either, but Laxman, man, that's a good name because this stock has been very lax. Is that the right word? No, probably not. Maybe I should just stick to stocks instead of playing word games here. But hey, Starbucks looks now to be trading at just fair value, and I guess all they needed was a new CEO for the stock to just go absolutely bonkers. So let's hop over to Seeking Alpha, take a look at the history of Starbucks. All right, so Starbucks now sitting here at 95.90, still down 23% over the last year. Year to date down 19.7. That couldn't possibly be right, could it? Oh no, because Seeking Alpha still is only just recording this at 73.01. All right, so scratch what I just said there. Let's look at the 5-year chart, though. That's really what I wanted to do here. So over the course of the last 5 years, Starbucks has primarily, if we look kind of here in the midsection here, is usually a stock that's around like $92, kind of at that midpoint. It does have stretches where it goes up over $100, and then it's really in sort of that overvalued category. I always like to, while it's still visible in the 5-year chart, you look at the COVID crash, but pre-COVID it was about 86, 87. It got up as high as 90. Even back in September of 2019, it was at $90. Had the COVID crash where everything went down. It recovers. It goes on a wild run in 2021, which is a really hot year in the stock market, probably because we printed off a bunch of money, and when there's a lot of money and liquidity running around in the system, it generally tends to go to stocks after a little while. 2022, we had a market correction. It became very buyable, crashing down into the low 70s. And then for most of 2023, it was 90 or 100, just not a great buy. So this was one that I was just sitting and holding and dripping and not really doing much of anything with through that stretch. And then when it dropped down here into the 70s back in May, it was, looked like a great buying opportunity. And it's just languished down there for quite a while. I launched the channel back in June of 2021, right in the middle of this little dip. And now it has shot back up into the mid 90s. So we'll see if it stays up here. But my assumption would be that everyone being excited about this new CEO is going to keep the stock up here for a little while. We'll just have to wait and see how all of that goes. But I'm not here to do any kind of predicting as to whether or not stocks are going to go up or go down or any of that stuff. All I'm worried about is that this number, dividend per share, continues to go up over time. Starbucks has a payout ratio in the low 60s last I checked. We'll take a quick peek at that and see if anything's changed. Yep, about 63%. Still a fairly safe payout ratio. Hopefully that eventually starts to go down a little bit, but at 63%, I'm not particularly worried about it. We've got a 5-year growth rate on the dividend of 9.24% a year, 13-year dividend growth streak. And, with this payout ratio being in the low 60s, maybe their future dividend increases look more like 6 or 7%. Again, that's just a guess. I don't really know. But listen, there's no question in my mind that Starbucks was remarkably undervalued down below $80. So that's the time to add. The reason that I want to add it there is because I want to get this $2.28 of forward dividend income for $75 versus spending $95 on it. It's really as simple as that, you guys. There's so much stuff out there that you can analyze with stocks. There's so many metrics that you can take into account. And listen, if you're looking at all kinds of different companies, mid caps and small caps, and companies that don't have a stable history, non-blue chip companies, you probably need to do a lot of that kind of research in order to have any hopes of making a profit or feeling good about your investments. For me, I want stable cash flow. That's what I want. These are qualified dividends. Qualified dividends. That means your qualified dividend income, if you're filing as a single person, you can collect $47,000 every single year in qualified dividend income, tax-free. It's an amazing tax loophole for us middle class type folks who are just trying to get ahead, and get a little piece of the pie for ourselves. That's what this channel is about, guys. Let's get the passive income. I'm amped up and excited today, if you couldn't tell already. But this is why we do what we do. So for anyone out there that's griping and complaining because we've been sitting here buying Nike and the tier 1 investors for the 18 to 30-year-olds, we've been doing this since the start of the channel. All right? It just goes to show some good news can happen. There could be a different CEO. There could be a really good quarter of earnings. There could be whatever headline, and a stock can just shoot way up. So you buy it when it's down, and then you sit and you hold it while it's up. Very simple. Taking a quick look at the other tiers here, no major moves or shifts here. We're still kind of waiting on some value in the tier 4. Tier 3, we've still got Hormel and Archer Daniels Midland in the buy zone. Tier 2, we've still got Target and Hershey sitting in the buy zone. But StarBucks has shifted down into the non-buy. It's just in the hold. Eventually, the same thing's going to happen with Target and Hershey, and eventually something bad, there's going to be a bad headline, a bad quarter, or something like that with one of these other companies that we cover just down here in the red, and then they're going to shoot up, and then we're going to buy those. This is simple. This is really, really simple stuff. This is stress-free investing. The only thing that's going to stress me out is if one of these 60 companies decides they're going to slash their dividend. At that point, I may pivot with that company. We may have to replace that company here on the channel with another one. And if any of you have watched, there is a playlist here on the channel called the Bubble Stocks playlist, which are an additional 40 companies that I'm not focusing on, but they're sort of the ones on the bench that are waiting in the wings just in case something bad happens to one of these and we do need to opt to replace it. But hey, a lot less worried about StarBucks going forward with new leadership, and I am going to just sit back and enjoy collecting that $2.28 a share. And I'm assuming, could be wrong, but I'm assuming that when they raise that dividend, I'm going to be getting a raise in per share forward income on each and every share that I own, and so will you, StarBucks shareholders. Big congratulations to you. All right, I think that's enough for me today. I am very excited. I might go out and just have me a little Starbucks beverage to celebrate the good news. Why not? Why not? I'm way up on that position right now. Feeling pretty good. Or maybe I'll hold that money back and use it to buy some more dividend stocks in the green category. Just have to see. Just have to see. All right, everybody. As always, links in the video description below to a video on each of the 4 tiers, which breaks down each of these different categories, why I picked the companies that made the final cut, why I invest in them with confidence, and also a link to an ETF themed video as well that's also age-based. Very happy to bring you good news today, investors. Keep on investing. Let's keep getting that passive income. And remember, when it comes to dividend growth stock investing, we're not trying to build a house of straw here with high yield, unstable garbage. We're trying to build a house of bricks with stable, ever increasing dividends. Patience and perseverance accomplish all things. Remember that, y'all. See you next time.